Good morning and welcome to the FNB Wealth and Investments digital media briefing. My name is Nick Riemer from the investment education side of FNB, and I will be facilitating today's discussion. Just a reminder to please send through any questions you have on the link, as our panelists will be addressing them throughout the discussion. Should the link not be working, please mail it directly through to Leka or Pelile for the same purpose. This webinar has been developed to give media access to some of FNB's top investment and economic minds, as well as to explore key market events, the different possible outcomes of these events, as well as possible opportunities that lie ahead. The markets have been difficult to navigate over the last 3 months as a result of the global pandemic. A major decline in March was followed by a recovery in April and May. Long-term investors have had to stay the course and resist the temptation to remove funds from long-term portfolios on account of the market vulnerability. The move to level 3 from the 1st of June has started seeing the South African economy opening up for business. This, paired with new government regulations as well as incentives, is going to have a massive impact on investments and the economy going forward. To take us through that journey today, we are joined by the following experts in their field. From an economic view, Siphamandla Mkhwanazi, FNB Senior Economist. From an investment and market overview, Renzi Thermalai, the Head of Investments at FNB. From a money management view, Esther Ush, the Head of FNB Retail Money Management. And lastly, from a strategic view, Becky Mkhize, the CEO of FNB Wealth and Investments. Siphamandla, starting our discussion on an economic note first this morning, I'm going to hand over to you now for the macroeconomic view.
Thank you, Nick. Good morning, everyone. So for us, it's been a pretty interesting time. Our crystal ball, I have to say, our crystal balls are pretty murky. They remain murky, and the outlook remains very uncertain. There are a lot of things that we've had to change in our models. We've had to recalibrate our models. We understand that some of the relationships might or might not hold post this COVID-19 pandemic. But just to give a bit of a summary of where we are in terms of our economic outlook, I think the point has been made a number of times, and I think pretty sufficiently, that we are probably going to see one of the deepest contractions in the South African GDP, the deepest we have in history, in our view. It's likely to range somewhere around the negative 8% range. But what is important, what is the important feature of our outlook on GDP is that we are likely to see more a permanent base erosion in our capacity to produce. You would have heard news flow. You would have seen news flow that some of the companies will not open even after lockdown, particularly in the restaurant market and in the manufacturing sector specifically. So there will be that element of permanent base erosion, which then suggests to us that what we are currently experiencing resembles more a reset. It's more a reset button that has been pressed, or rather than a pause button. Yes, some of it will be made up during the recovery phase that I will describe just now, 2021 and 2022. But it's only a partial recovery. In other words, we're not going to recover all of it. The pie is going to get smaller, and the important assumption there is that we don't do anything about it. So that is an important assumption. So if nothing gets done about it, I know that the president a couple of months ago announced that they are working on phase 3 of South Africa's response to COVID-19. And part of that was a promise that they will speed up, or they will accelerate the implementation of some of the structural reforms that had been suggested before. For example, the National Treasury paper that came out sometime last year. But we are assuming for now that in the absence of further detail, we are assuming for now that we're not going to see any of those. Now, how we've looked at it is that we have to look at it from both the demand and the supply side. So from our perspective, when you look at the supply side and looking at what industries are allowed to operate at what level of lockdown, you get a deeper contraction of around 10%, so double digit. But we know that there has also been a stimulus package, for example. We know that there has been aggressive interest rate cuts, which will assist, but in our view, probably not enough to prevent a deep contraction. So if you take all of that into consideration, you get to a number of around 8%, and perhaps the truth will probably be somewhere there in between 8 and 10%, depending on how companies react, because there is still that probability that even under lockdown. Under level 1 lockdown restrictions, some companies will just not open, or the behavioral changes from consumers themselves. For example, the traveling, the going to restaurants. So even after lockdown level 1, you might still see activity not as vibrant as compared to 2019. So that's the important feature of our focus, that gives us sort of an L kind of a shape in our GDP trajectory. But if you look at the chart there on the right, it resembles a V, which just it's just a mathematical, it's a technical depiction if you compare a deep contraction this year to what we will see next year. But what's important is that the recovery next year is lower than the contraction we are going to see next year. We think that we will touch in certain quarters of 2021, 2022, we will touch GDP growth of around 5%, but it's coming off from a very, very low base, which we are likely to see in the coming months when Stats SA starts releasing data. And obviously, this will have major implications for the labor market. In our view, we're likely to see massive job losses. We wouldn't be surprised if they add up to around 800,000, at least 800,000 in the first round at least. And what comes after that will be dependent on how corporates and how households react. So that induced effects, the additional job losses as a result of changes in behavior by households. For example, if corporates prefer more technology than physical labor, or if households change their spending behavior and, for example, prefer to sit at home instead of going to restaurants, so it will have those kind of implications in some sectors of the economy. Now, if you combine then all of that, it does suggest that we are probably going to see this low demand theme continuing to 2022, or at least in the forecast horizon, which then suggests that we are likely to see very low inflation rate throughout the forecast trajectory. We are already seeing deflationary pressures in some goods and services. For example, in clothing and footwear, because of the changes in behavior, we are likely to see a continuation of that trend. I'm wearing a suit now. Before March this year, I would probably wear a suit almost every day. This is the first time since March I'm wearing a suit, so I don't need to buy suits anymore. So such items will likely experience price deflation. And if you look at other big items such as rentals, the rental market at the moment is actually facing a risk of deflation. In other words, rental prices actually going down. So if you combine all of that, you end up with this picture. You see this picture where prices just remain low for a long period of time. And if you look at what's happening globally, inflation is just almost non-existent at the moment. So inflationary pressures very low. In fact, we are talking of deflationary pressures now, which then leads us to believe that there probably is more room for the South African Reserve Bank to cut interest rates, probably by around another 50 basis points. But the timing at this stage is still unclear. We do think they'll probably pause for now because the economy has been locked since since the beginning of March, we haven't seen the impact of these aggressive interest rates cuts that the South African Reserve Bank has given to the consumer. So maybe the next step for now will probably to wait and see and allow the impact of those interest rate cuts to filter through into the economy, and then decide based on the data at that point in time whether further interest rate cuts will be prudent. But if you look at the numbers, if you look at the potential inflation trajectory, we are likely to see more interest rate cuts. Now, to sum it up, the recovery in 2021 to 2022 will come, but in our view, will be partial, and that's dependent on us whether that recovery is partial or not, or whether we recover all of the lost capacity during this lockdown. Whether we recover all of it will be dependent on how we react to this, and that's when the phase three response to COVID-19 will be important for us. That recovery is a result of our expectation of a rebound in global growth. We have started seeing some activity in countries that have reopened their economies, such as China. We have started seeing some positive activity there. So we believe that rebound will probably lift South Africa, particularly our exports to China, especially export of industrial goods. It will also be as a result of the lagged effect of the monetary policy that we have seen. I've mentioned the aggressive interest rate cuts. They do tend to impact the economy with a bit of a lag. So the combination of all of that gives us that rebound in 2021 and 2022. But what's important for us is that during that period of recovery, we will continue to see reallocation of resources. Yes, there will be job losses, but some industries will make new jobs. For example, for sectors such as retail, they will have to employ maybe health practitioners, because now consumers are more health conscious. And those are jobs that didn't exist before the shock. So there will be that reallocation of resources. And lastly, this reset in the economy suggests to us that we are probably going to see a winner takes all kind of a situation, which means that if you are lucky enough to remain in the labor market, if you are lucky enough to be employed throughout this period, probably going to find a number of cheap assets out there. If you think about what's going to happen in the car industry, you are likely to see your Avis, your budget cars, disposing of their cars because demand is ridiculously low. And then you start thinking about what that impact will have on second-hand cars, and you start thinking about what impact that will have on prices of new cars now. So those that are lucky enough to remain employed will probably find cheap assets out there, be it cars, be it houses, and stock prices for that matter. So it's a kind of a winner takes all. And in sum, yes, outlook remains highly uncertain. We will keep our close eye on developments. We are waiting for Statistics South Africa to start releasing GDP data sometime this month. We are also looking out for Treasury's reworked budget to see whether we will see those much awaited structural reforms. So I will stop there and happy to take questions if there are any.
Thanks, Siphamandla. Just a basic question around what is the South African Reserve Bank's thinking when they cut interest rates? What is the theoretical impact on the economy and the markets when that happens?
Right. So the channel is really through the savings on debt, and the assumption is that consumers will then use that little bit of saving and spend it on the economy. So it's got that stimulative effect. Now that's an important question, especially around this time, because remember I mentioned that we haven't seen the impact because the economy was locked. So we don't know how consumers have reacted. At this stage, we don't know how consumers have reacted to these interest rate cuts because some they couldn't spend some of that money. Some of the goods were locked. So that really is the thinking behind it. The assumption is that the little bit of savings in the consumer's pocket will be spent on goods. Now, it's a big assumption during this period, because if the uncertainty hangs, and if job and insecurity, for example, that uncertainty around the labor market hangs, it's like you're likely to see, especially your higher income households, actually saving those little bit of savings and putting them aside, and rather than spending them. And then if that happens, you lose that stimulatory effect of an interest rate cut. So it depends on how households react to that, and it's linked to consumer sentiment. So that will be very important in how effective these aggressive interest rate cuts are. But in terms of what they actually look at, it's mainly inflation and the levels of demand in the economy.
Okay, perfect. Thanks, Sipamandla. Secondly, the South African Reserve Bank has been warning with regards to increased government debt and the fact that debt is set to accelerate. What is the impact likely to be on state-owned enterprises like Eskom and SAA as a result?
Look, it does mean that the government's ability to continue bailing out state-owned enterprises or intervening in state-owned enterprises operations will be much more limited now than it was in 2019, which then brings us to a possibility of some of disposal of some of the state-owned entities, either partially or wholly. But fundamentally, I think it will be much more difficult now for the state to continue bailing out these state-owned enterprises, particularly because consumers are now much more conscious about the developments and thinking about what this shock will have, the impact this shock will have on the labor markets. We're likely to see more and more social unrest. Which limits the government's ability to continue supporting these industries instead of expanding the capacity of the economy and achieve that full employment.
Thank you, Sipamandla. Moving from an economic view now to a markets and investment overview view. The impact COVID-19 has had on markets, Renzi, can you talk us through that, as well as some of FNB's house views towards investments at the moment?
Thank you, Nick. Good morning, everyone. There's so much has happened and there's so much to talk about. I almost felt when I was preparing for this that I was doing an annual review on markets. We've managed to condense sort of 12 to 18 months of market volatility into just the first couple of months of 2020. So it's definitely one for the history books. If we reflect on financial markets so far this year, you first saw markets sell off quite violently from middle of Feb to middle of March, as the spread of coronavirus and the impact of subsequent lockdowns on the economy weighed on investor sentiment. To give you a sense of sort of just how violent that move was, in the first 20 days of the sell-off, we fell the same amount that it took us to fall in 100 days in 2008. So it was 5 times as quick as the 2008 sell-off. So it was quite a significant shift and quite swift as well. However, since then, we've seen, to be honest, quite remarkable recovery, largely concentrated in April, and markets now actually stand marginally lower than their pre-crisis levels. In some instances, like at the S&P, is actually positive year to date. We've also seen unprecedented levels of fiscal and monetary stimulus, which I think is undoubtedly supporting the market and contributing to the rally we've experienced. So I think the key question at this point is just how sustainable that rally is. And I'll maybe comment a little bit on that later. If I look at our FNB house view, specifically on asset allocation, I think the clearest description of it would be at a high level, we favor fixed income and offshore exposure in the current environment. Inflation is well contained, as Sipa's alluded to. Cash rates have moved much lower. Bonds were at quite oversold levels in the middle of March. And so all of this contributed to our overweight in fixed income. When it comes to South African equities, we have a focus on defensive quality names. The negative local economic environment leads us to a preference for direct offshore exposure and exposure to counters that derive a large proportion of their earnings offshore, so your traditional sort of rand hedges. SA property is a particularly interesting one. It kind of provides you with this classic dichotomy between valuations and fundamentals. Valuations at recent market lows were sort of the most attractive since I think the mid-90s or late 90s. And so there was quite an opportunity in there. But on the other hand, we're faced with this big question mark around fundamentals. I mean, I think Sipamanda talked a little bit about it. So what will rental levels be? What will vacancies look like? What is leverage going to look like when capital values normalize? How many property companies will see this crisis out? And to what extent will structural demand for property be impacted post-COVID? So all of this leaves us in sort of an uncertain territory when it comes to property, and so we've adopted a cautious stance there and have a marginal underweight position. If you look at offshore itself, I mean, offshore exposure has a natural benefit to local portfolios. Firstly, they give you diversification and a wider opportunity set. And then secondly, the Rand provides a sort of natural cushion to your local currency returns, especially during times of market stress. Presently, the levels of fiscal and monetary stimulus in global markets, I think, provide a sort of natural floor. So we could see continued strength in the near term, and we remain overweight offshore. I'll talk a little bit about the Rand as well. I know it's always topical. The Rand obviously sold off quite sharply this year, but I think it's important to note that this was pretty much in line with major emerging market peers, like maybe Brazil, Russia, Mexico. So that tells you that the sell-off was largely due to global sentiment and risk off, rather than any idiosyncratic risk specific to South Africa. There has been some strength recently, though. So May, for example, was the first month where we saw the currency strengthen rather than weaken. And the Rand is a naturally volatile currency, so it's incredibly liquid and very tradable. And whilst currencies are in any event difficult to predict, the Rand is even trickier to call. Listen, this doesn't stop us from trying. So currently we see strength on the cards for the next little while, and our fair value for what it's worth sits at around 1650 or so at the moment. If we take a sort of more medium-term outlook, we can see the Rand reaching probably close to 1550 towards the end of next year, so the end of 2021, notwithstanding any sort of interim volatility along the way to there. And then from there on, our models sort of just project the usual structural depreciation of around 4.5% per annum. So if I just bring it back and close off on the current sentiment and recent market rally, I think it's a couple of important points there. So is the market rally sustainable? Yeah, I guess that's really the million-dollar question. So let me start by saying that in times like these, with such high levels of uncertainty, forecast risk is significantly elevated. So having strong conviction in any particular outcome at this point is difficult, as you probably have balanced odds of being right or wrong. In my view, there are probably two major factors or forces, if you will, that are driving markets right now. So the one is the economic impact of COVID, and naturally that's sort of a major headwind. And then the second is the fiscal and monetary stimulus in seemingly unlimited quantities, which is your major tailwind. Now, where markets go from here kind of largely depends on the balance there and which of the two forces is stronger. It's probably worth reminding you that the longest bull market in history ran from the global financial crisis till about February this year, and that was largely driven by quantitative easing. So it's probably unwise to underestimate the impact that sort of stimulus can have on the market, and eventually, hopefully, on the economy. Similarly, though, the economic slowdown in economic activity we're currently seeing is truly unprecedented, and so we have two kind of very strong forces acting against each other. I think what's key is how quickly we can get the economy back towards some sense of normality, and Sipamanda spoke about that as well, because that gives us higher visibility around how much permanent versus temporary damage has been done. So how much damage is permanent, where those businesses don't open up again, those people don't go back to work, and how much of it was temporary, where you can at least run, even if it's at a reduced level. This, of course, is a second order effect on how the virus itself plays out, and whether we have sufficient healthcare infrastructure, effective treatment protocols, and potentially a vaccine soon enough to avoid overwhelming the system in the event that we see a second wave of infections. So I think I'd leave it at the situation, therefore warrants close monitoring. But our current view, for what it's worth, is to remain broadly neutral on global equities, which means we're not materially betting against global central banks, nor are we ignoring the magnitude of the impact of lockdowns on the global economies. I'll probably leave it there, Nick, and see if there's any questions or comments.
Perfect. Thanks so much, Reen. touching on what Sipamanda was saying around the South African Reserve Bank reducing interest rates, how have you seen the recent cuts impact investments? And then what is the thinking around further rate cuts in terms of impacting them going forward?
Sure. So the Reserve Bank's cut quite significantly this year. I think we currently see it, and certainly if I just look at the market itself, the market's pricing in another 50 basis points down the line. So that's the current view that's, I guess, widely shared in the market. The impact of cutting rates is interesting because in our world we have a diversified portfolio that we want to build, and so I have to look at the relative attractiveness of all the assets. So by cutting rates on the economic side, I get it lowers the cost of borrowing, etc. But on the financial asset prices side, it makes certain other asset classes more appealing. So your risk premium increases on things like equities. Your duration assets like fixed income become slightly more attractive, and cash becomes less attractive. So when building a balanced portfolio, we are now less inclined to use cash because it is now less attractive than other assets. So you start to look around for alternative exposures to returns rather than the depressed levels that you're getting on cash. So that's probably the biggest impact from a financial market side, is it spurs an interest in risk and yield. So it leaves investors searching for yield and searching for extra risk to generate return.
Thank you so much, Renzi. We've got a question from Gareth Stokes, SIPA, and it's directed at you. Gareth Stokes from Stoke Media. We keep hearing about structural changes, proposed structural changes. What exactly is the government referring to?
Right, so it's a term we have used for the past, I don't know, 15 years or so. It encompasses a lot of things. I will touch on a couple of sectors. For example, you can take the energy sector. One of the biggest constraints to South Africa's potential growth is our constrained energy supply. Now, and that shouldn't be really in a country like South Africa that has resources, natural resources. So it would revert to things like that, such as reforming our energy supply mix, more green energy, more renewables, wind farms, your solar system, and the like. So in the energy sector, that's more how I see it. You can take also the communication sector, the rollout of the spectrum, which lowers the cost of doing business in South Africa. We are still lagging a bit behind in terms of our e-commerce. So the rollout of that would increase competition in that space and lower data costs. But generally, there was a study that was done by UJ a couple of years ago, which identified specific industries in South Africa where barriers to entry are unacceptably high, which then leads us to a very concentrated economy, which we know that has undesirable effects in that it keeps prices high and it increases inequality. So it's dismantling of such barriers to entry. It's reforming our educational outcomes. Our educational output at the moment is not fit for what the economy, not fit for the purpose of the economy. So it's such things. Some are short term and some are more long term. And the long term ones, unfortunately, tend to be costly in the short term, but the benefit over the long term tends to be high. There are low hanging fruits such as the rolling out of spectrum, as I've just mentioned, and the quickest way to achieve all of that is to actually improve confidence. So those things could actually improve confidence and unlock investment into the South African economy. And over the long term, you can then focus on educational outcomes and such things.
Thank you, Sipa. There's another question that's come through from Lamiz Omarji from Fin24, also directed at you. In terms of lower prices for property and cars, is there a timeline for when we might see this effect on the economy, either this year or next year?
Right. So on property, the unfortunate part is that there's no market at the moment with everything being closed. But we have started seeing some transactions that, the pressure in the property market actually started before the crisis. What this is doing is just accelerating it. We have already started seeing it. But over the next couple of months, we are likely to see very attractive prices if you are a buyer, with the heightened uncertainty with some sellers. In distress disposing of their assets and the like. So over the next couple of months, we're probably likely to see more deeper contraction in nominal terms for house prices. Car prices, on the other hand, I think that we are likely to start seeing that impact towards the tail end, towards the end of this year and leading into 2021. It does tend to also react with a bit of a lag. So we are looking at the next couple of months to mid 2021, if I can put a timeline on it.
Thanks, Sipamandla. Renzi, final question for you before we move on to money management. On Sasol's side, there's obviously been a lot of attention on Sasol lately, and we've seen a recovery now in the last 2 weeks. What is the reason behind the strong rally that Sasol's had?
It's always difficult to pinpoint the precise reason for movement over a very short period of time. But I think part of the major issue with Sasol was just this link to the oil price. So oil prices fell quite significantly on the back of the recent sort of price war between Saudi Arabia and Russia. And I think what we've seen since then is a sharp recovery in the price. So we're now at above $42 on Brent. That's obviously supportive for Sasol. They depend very much so on the oil price in rands, however. So I think that's an important point. So the rand price of oil is what impacts Sasol's business. And I think the higher that oil price goes, the more confidence people had that Sasol could see this crisis through. So, when it was down, the share price went from sort of 300 odd down to 20 odd. So, that's a significant fall. When it was at 20 odd, I think there were part of that sell off was just people not having confidence that the business would be able to see it through. And those people were probably more comfortable to sit on the sidelines and see how things played out. Now, Sasol had hedged their oil price at $32, so they were quite comfortable to kind of sit through that little period. They'd worked with their debt holders and sorted out any short-term kind of strain they might have had on cash flow to help see them out. And there was a lot of talk about a rights issue, which also stressed the market out a bit more. That sort of all played out. We've come to what's looking like a calmer period in the market. I said it before, the market's now rallied quite hard. Oil's moved up. So things are looking a bit calmer, and then people probably reflect on the fact that actually the share price had fallen, sort of 90%. What is a fair value for it? So it had jumped up to 150, 170 or so, still, 40, 50% lower than it was previously. So I think it's just a little bit of confidence returning to the viability of that counter over the long term.
Fantastic. Thanks, Renzi. Good morning, Esther. I think we've now had a full view with regards to how COVID-19 has impacted both the economy and the markets. COVID-19 has also had an impact on consumers directly. Can you talk us through how COVID-19 has impacted consumers, as well as tips from your side, from a money management view, with regards to stretching current sources of income to meet new expenses going forward?
Yeah, thanks. Morning, Nick, and morning, viewers. Thank you very much for the opportunity. COVID did hit us a little bit by the wayside. And it seems as if there's a lot of doom and gloom if you listen to Sipamandla and Renzi as well in the market. But this is the time that a person can actually take the opportunity to reflect and review about their own spending and actually make those small little nuances to free up some cash flow. So, the quickest and easiest way that I can talk to the consumer out there or make some tips for the consumer out there is, in the last couple of weeks, there's definitely been a decrease in the amount that you are spending on transport and entertainment. There's been an increase in the amount that you're spending on groceries. I can see it with my own bill as well. My grocery bill has gone through the roof. But you've decreased that transport and that entertainment. So, take that money that you've saved there and put it towards your sort of saving and paying off your debt as well. Another thing that consumers can do to sort of set themselves up for financial resilience is to make sure that there's some insurance houses that reduce their monthly premiums. That little bit of a saving that you've made there, put that towards paying off your debt. Then also there's some places that aren't taking debit orders at the moment. So for instance, some gyms, that money that you've saved there, put it towards paying off your debt and also starting that emergency savings. Now, Sepa Mandla hit on quite a big thing is there's been this massive interest rate reduction in the last couple of months, 2.5%. So, if you look at you paying your bond, you're paying your car installments, there's a couple of things that you can do. You can either continue paying at that previous rate, or alternatively take some of that money that you're paying or saving on your bond and putting it towards paying off your short-term expensive type debt, or alternatively taking it and putting it towards emergency savings. So really setting yourself up for financial resilience going forward. But the big thing that I need to stress is a person mustn't make knee-jerk reactions at the moment. And Renzi, I think this is to your point as well. There's a lot of noise in the market in terms of the economy, the markets and all of that. If you are contributing to monthly investments, make sure that you continue contributing to them. Don't stop anything. Don't cash anything in. Make sure that you just stay the course as well. So one of the big things that we'd also like to do and like to sort of say to consumers and to people out there, this is quite a nice time to also reflect on what your finances are, where you are in your finances. So almost that think, dream, reflect. Where do you see yourself financially in the next couple of weeks, months, and years? And then you need to prioritize from there and then see, are you spending money on what you actually value? So if you value your kids and value financial freedom, is that where your money is going? And then you've got that value in place, then start actually trade-off and action and putting plans in place to start spending that money where you value. So quite a couple of little tips in there in terms of free up cash flow, put it towards your short-term expensive type debt, or alternatively keep paying or start some emergency saving, and then also truly look at where you are in your financial state and how you can set yourself up for financial resilience.
Esther, for those consumers who haven't gone and worked out their cash flow as of yet, what tips do you have with regards to preparing your first cash budget?
Oh, that's a good one. And this is a drum that I always beat. You always need to have a look at those sort of needs and wants and be very cautious of that unconscious spend. So the needs are the things that you have to pay every month. It's your rates, it's your taxes, it's your bond, it's your insurances, it's school fees, it's those type of things. Those are the absolute things that you have to pay. The wants are the nice things. These are things like clothing, it's entertainment, which we're not spending on at the moment. That is the wants. You obviously want to make sure that you can cover all your needs before you start going into your wants. And then that unconscious spend is a big thing. It's the spending that you do unconsciously. So by means of, and the best example there I have is literally, it's the chocolates that jump into the till as you're about to pay. Be aware of those little unconscious ways that money's going out. So always go back to the basics, needs versus wants, and where can you save on the wants and make sure that you cover your needs.
Thank you so much, Esther. Have we seen an impact now, especially looking at grade 7s and 12s? It's been a topic in the news with them going back to school. How have parents been impacted in this time with regards to saving for their child's education?
So it is a big thing. I mean, there has been this just general shock in the system in terms of COVID. But remember that saving for education and providing for your children's education is very much something that you need to do. So there's a couple of ways that you can do it. You could either start saving for a kid's education from the minute that they're born, or alternatively, these savings that you've made on interest rates, that you've made on not spending on the entertainment, you can redirect all of that towards saving for your kids' education, making sure that you also set them up for the future.
Great. Thank you so much, Esther. Sipamanda, we've got another question for you coming through from Becky in Lovana from Ilanga. He wants to know the following. Obviously, there's going to be a dramatic increase in the public debt as government is planning to borrow money from the IMF. What is going to be the social impact of growing public debt going forward?
Look, that's an interesting question, especially around this time. the first thing to point out, so far as debt levels are concerned, is that we are not the only ones. We are not alone in this problem. It's a global, it's a global trend. Every country that has been hit by this shock has had to go out somewhere in the market and borrow a bit more in an attempt to respond to the current crisis. So everyone's debt is probably going to lift after this. Now, what's going to be important for me, I think that it's not so much about debt over the next medium term. It's more about your GDP, because debt is only a problem in relation to your GDP, right? Now, everyone's debt is going up. I think it's going to be more a question of how quickly can you grow your GDP so that your debt to GDP ratio normalizes, right? So it's going to be more about the quality of spend rather than the debt level itself. So I think over the next over the medium term, debt levels in fact are going to rise. I don't think that per se is going to be a problem. I think more emphasis will be on how are we going to grow our GDP this time around, because as I said, your debt is only a problem in relation to your GDP. So your GDP is going to be mostly what you are mostly concerned about. And I'm glad this question comes out at a time when there's a book that just got released yesterday called The Deficit Myth. It actually suggests that this deficit story shouldn't really be much of a problem, especially in times of crisis. So to give a short answer, I think more emphasis will be, and I think there's a general understanding within government that during this period, over the medium term at least, the problem is going to be how are we going to grow our productive, our GDP rather than the debt level, because that affects everyone.
Sipamandla, second question from Becky and Lovana. How likely are we to see a sharp increase in taxes, specifically VAT and personal income tax?
Yes, it's linked to the first answer. I don't think that there is any more scope for the government, at least in the medium term, to increase taxes. Already, even before this shock, we were already facing problems of not raising enough taxes, even after increase in tax rates. So we were already, because our tax pool was already constrained, and now we are talking of further job losses. So it would be counterintuitive, really, to increase taxes under these conditions. I don't think that would ever yield any desired increase in revenues, particularly because your tax revenue has reduced. Your economy is not performing particularly well. I think that, as I said, I think that what would be more important over the medium term will be quality of spend. You might actually see more spending, but what would be important is the quality of that spend. What are you spending on? Are you spending on programs that are expanding your capacity, education, health? And if you listen to remarks by the ruling party and the Reserve Bank governor, the Reserve Bank governor actually said that South Africa potentially will have to, create those redundancies. So spend on things that we don't necessarily need right now, but will provide us buffers when we hit such crisis. So that would include things on spending on infrastructure. So we will likely to see a massive expansion on infrastructure, which will require more debt, but because it has those positive impacts on GDP, that kind of spend doesn't really raise the ire. So it will be about the quality of spend, I think, going forward.
Thank you, Sipamandla. Becky, we touched briefly on it at the beginning with regards to investors staying the course. What advice do you have for consumers in staying the course in this volatile time?
Thank you, Nick. Good morning, everybody. What we've been telling clients, and we continue to tell clients, is the importance of staying invested, sticking to their plans, sticking to their investment objectives, not getting too worried about short-term fluctuations. As Renzi said, at some point, our market was down about 25%. We've recouped most of those losses. We If you think about, I mean, you spoke and asked about Sasol. Towards the end of March, Sasol was down significantly. It's now 700% up. So we're really telling clients not to panic, because typically what happens in that instance is clients tend to then buy high and sell low. If you just think of in the US markets, over the years we've had various financial crises, we've had terror attacks, we've had other market crashes, but the average return throughout that period of US markets has been 8.5% a year. But the average investor return on the other side is actually 4.25%, which tells you that there's sort of a behavior gap between what investors are getting and what the market sort of is giving, because they're not staying invested. And that's due to things like greed and fear, and not sticking to your plan as indicated. So we're really encouraging clients to stay the course, and you know, there will be a recovery, and as we've had in previous crises. And to help clients, we're working with them on the money management journey. Some of the things that Esther spoke to, which we're doing as a bank. We're also strongly discouraging clients from tapping into their retirement funds in this period. We're asking clients to continue to contribute into retirement funds and products. We know National Treasury, as an example, has you know, allowed clients to draw a little bit more from their living annuities over the next couple of months because of the crisis. But I mean, obviously, together with their advisors, they need to look at those situations. But the risk there, obviously, is that people can then deplete their capital and have nothing left. So we really are encouraging people, you know, where possible, not to tap into any of their retirement funding, which they need one day. I mean, one of the other things that, just to highlight, what are we doing as FNB Wealth and Investments to help clients in this uncertain period, and as FNB, we really want to help clients to secure their financial future. We really want them to help them manage their money better. So we are trying to make sure that we link their investment objective to goals that are tangible, that, you know, people can actually relate to, or of saving for kids' education, or saving for retirement, and those kind of things, so that we can then track and help them to track and keep up with whether they're still on track to meet those objectives or not. So we're doing a lot around investor education, a lot of thought leadership pieces that we're putting out there for all our clients, whether they have investment products with us or not. And we feel that investor education is quite important to get savings and investment going in the country. Because for people that are not investing, it's important for them to know, you know, why they should be investing. And for those that are invested, it's important to also keep them invested for the reasons I mentioned earlier around the behavior gap, and how people miss out by going in and out of the market at different points. What COVID-19 has allowed us to do is use our digital platforms a lot more than in the past. So we're able to reach clients on the FNB app to read some of those thought leadership pieces. We've been able to have a lot more, you know, webinars and digital events, which surprisingly have been very successful and very well attended compared to the normal face-to-face client events that we've run in the past. So the reach has been a lot more massive in terms of assisting clients with the information that some of the experts spoke to earlier, and we're able to then answer their questions and on the go. So for us, it's how do we, you know, make it easy for clients to invest with us, stay invested, simplify sort of the investment jargon, and take out, you know, all the things that are confusing in the market around, is it active, passive, should I invest local, offshore, to assist them with that.
Thank you so much, Becky. What are some of the alternatives that clients have, as opposed to dipping into their savings and retirement savings funds, etc., to meet some of the expense needs at the moment?
So we advising clients to, where possible, speak to their product providers. So if they need some debit order relief or some debit order holidays for investment purposes, speak to your provider and get maybe the payment holiday. Also, where perhaps they need some help in terms of fee relief, also we're asking them to come in and talk to us and or some of their other providers to help them with that. And then in the broader bank, I guess the big relief is really around some of the debt relief that and cash flow help that Esther spoke to. So those are the things that we really are trying to help clients with in terms of some of their short-term expenses as a result of this crisis.
Oh, perfect. Thank you, Becky. I think that addresses that. Going to open up the floor to questions now from our attendees. I think it's given us the last 5-10 minutes just to address all the questions that have started coming through. I've got one from Nisa Mudli from the Sowetan, and I think this could be addressed to all of you. With regards to expecting to see a big shift to online schooling as parents cater for social isolation measures, what is the cut down on school fees? Are we expecting to see a big transition now in normal schooling methods moving away and online becoming more sort of the more focal point then with the reduction in fees then as well, Esther?
Sorry, talking furiously and my mic's on mute. Sorry. So I think this is a question that both Sipho Mandla and I maybe need to talk about. So, with kids potentially starting to do homeschooling, there might be some fees and things that won't be paid. Some of them might not. There might be a small reduction in actual school fees, but I'll let Sipho Mandla, Renzi, and Becky take that. But even if that does happen and the students are starting, or the scholars are starting to work from home, there are still other considerations when it comes to a money management point of view. You might not be spending on transport, but now what is going to happen is your data costs are going to go up at home. Your electricity is going to go up. Your grocery bill is going to go up. So you need to factor all of that into account when you start looking at that holistic family budget. So you're not unaware. So yes, school fees may come down, but I'm going to leave that to the economists to talk to. School fees may come down, but there's other costs, ancillary costs that will go up. So you just need to again look at it holistically. Sipho, I don't know if you.
Yes, spot on there, Esther. I just want to add to that. So for us, it just means that there are services, not just education, but education is an important one for this discussion. There are services, and I mentioned in my opening remarks that are facing deflationary pressure. So education is one of them. What the crisis has meant is that consumers will be a little bit more price sensitive now because now they have options. We've learned that you can actually homeschool, you can actually enroll your child, and anywhere in the world for that matter. You can find ways of doing that. So the things that we previously wouldn't mind paying for, all of a sudden we will now start asking questions. So I think we are transitioning into a world where price sensitivity is just going to be a little bit higher in South Africa, which then brings us into a world where inflation is just low for a long period of time.
Renzi, a question for you. Has FNB seen an increase in investor appetite? And where are people putting their money, local or offshore?
Yeah, so I think Becky might also be able to comment there. So we've definitely seen an increase in appetite for the sort of stockbroking type of accounts where people have discretion to purchase, shares like Sasol, for example. I think our account volumes there have grown quite significantly. So that's been the trend we've seen recently in terms of specific opportunities. So rather than a general trend, people have been really looking out for the opportunities that have presented themselves over the last couple of months, because quite a few shares were at quite depressed levels. So there are lots of opportunities there. In terms of a more regional kind of demand, it was difficult for investors to maybe commit capital to offshore markets at levels of the rand was over 1940 at some point. So it's that sort of just the bad timing of it, that the time when you want to go offshore and during a market crisis, it's difficult because of the level of the rand. We are, from my side, I must say, I haven't really seen a strong demand for offshore play out in that sense. We've definitely seen a strong demand locally for people opening up accounts where they can buy shares and invest locally. Becky, I don't know if you want to comment more on that.
Yeah, so I think Brent is correct. Strong demand for share trading over March and April. It continued well into May. Lot of first-time investors into that space, and as Renzi says, I mean, most of them we saw into shares like Sasol, some into some of the property counters, and as and when news happens, I think people are piling in. So in the last 2 days, we also saw quite a lot into EOH. Renzi is correct. In offshore, we saw quite a big pullback, mainly, I guess, as a function of the rand being at 19. But the other area where we have seen quite a lot of money still going in is into cash, onto some of our deposit products within the bank. So I think that also tells you clients are still cautious around, whether this sort of market turn is sustainable, or are we still likely to see some further pullback in the short term.
Becky, for consumers who haven't yet opened up a tax-free savings account, what advice do you have for those specific consumers? Is it worthwhile opening up a tax-free savings account at this time?
I think definitely yes. So for anyone who wants to, as a first sort of foray into investing, I think the tax-free savings account is probably one of the things that you should consider, given you're getting up to 36,000 rand a year that you can invest, and tax-free. So that can have long-term sort of capital growth without any tax reduction on that. So definitely, I would. In fact, we encourage most of our clients to at least have a tax-free savings account, particularly more so for people, I guess, with kids who. It's a nice, easy savings vehicle for kids for saving over the long term. So definitely.
Perfect. A question from Onke Dumeko from Destiny Magazine. Sipa, I think this is directed at you. How long will it take to recover the projected 800,000 job losses, reallocation of resources aside?
Right. So that is dependent on how quickly the South African economy recovers. In our projections, it should take at least about 2 years for us to get back to the 2019 level. So that's on GDP. Now that assumption is also that projection is also based on the assumption that the historical relationships do hold. So now, if things do change post-COVID-19, for example, that in the manufacturing sector you are seeing more technology than physical labor, then obviously it will take a little bit longer to make up those jobs. So we are looking at a 2 to 3 years kind of a period for us to make up those jobs, but it's dependent on how we respond to this, how quickly we respond to this.
Another question for you, Sipamandla, from Sipalele from the Business Report. How realistic is this partial rebound in South Africa's GDP for 2021, considering that the economy has been struggling to grow at least 2% for the last 5 years and had just entered a technical recession just before COVID-19?
Yes, so that's basically the reason why we are saying a partial recovery. So it's not a full recovery. In other words, there's a step change. If we were here in 2019, we will start from here in 2020. So it is a step change. There are supporting fundamentals post-COVID-19. We've mentioned low inflation. We've mentioned low interest rates, which puts a bit of more cash in consumers' pockets. And with South Africans having a high propensity to spend, we might see that stimulative impact. But also, if if you think about what got us here in the first place, yes, part of it is pre-existing weakness. Part of it is a deliberate locking of the economy, right? So the economy was not functional, and that's why we have such a deep contraction. Now, if you open up the economy immediately, you already make up some of that, right? So already, if you open up, just by opening up and keep things the way they were before, you already have that partial recovery. So it's supported by the fact that, number one, the economy was locked, now it's open, so production resumes. Number two, there are supporting fundamentals to the consumer, low inflation, low interest rate, which will then give us a bit of a recovery. But that's 100% correct that we don't really get back to the 2019 level immediately. It will take a bit of time for us to recover.
Becky, you cautioned against the use of retirement funds to cover cash flow constraints. Is there a trend that FNB is seeing in this regard, especially in light of the potential job losses across sectors?
We haven't seen a big trend around it. What we have seen is, particularly with business owners or entrepreneurs who've had to close their business for some time. So the requests have come more from those who would like to access some of those retirement funds that they have just to keep their business going and alive. And in some instances, some people have asked, can we not even chat to the regulators to allow more leniency on some of the other retirement products beyond just living annuities. So we haven't seen a big demand from customers wanting to access those retirement funds. Esther, I don't know if on your side if you've got anything to add.
Sorry, that's a very good question. So, we have seen it's almost an accidental trend. So people, if they unfortunately get retrenched where they are, they don't realize the implications of cashing in their pension fund. So we need to very strongly caution against people cashing in their pension fund at this moment in time, because of the long-term effect of cashing in your pension fund. Now, you're actually physically taking steps and bounce backwards in setting yourself up for the future. So if you can, leave your pension fund savings, rather put them into a preservation fund, a retirement annuity, one of the other solutions that are available, so you can preserve those retirement savings for the long term. Leave them. And also the tax burden of cashing in your pension fund early is quite punitive. So rather leave that, let it grow so that you can set yourself up.
Renzi, what would be the best way for a beginner investor to get offshore exposure?
Yeah, so I think the traditional barriers with offshore exposure would be the process of getting your money offshore, the minimum sizes, etc. So the easiest way of getting offshore exposure, I would suggest, would be through local unit trust products in the market that have quite low entry points. So you can traditionally buy into a unit trust for as little as 500 Rand. Some of our stuff is actually priced at 300 Rand a month. So that's probably a good starting point for you, because it's Rand denominated, but you still get the currency exposure, gets converted back into Rand, and then you get a feel for what it's like to invest in offshore markets.
Perfect. Thanks, Renzi. And wrapping up, Esther, last question of the day before we conclude. With the decrease in interest rates, is it the right time for consumers to increase their debt levels, or should they try and avoid this? Just your microphone, Esther.
Sorry, again. So I would be cautious about debt. So remember, you've got your two different types of debt. You've got your secured debt, your unsecured debt. So your unsecured debt is your expensive type of debt. Obviously, with the reduce in interest rates, you want to try and pay off that type of expensive unsecured debt off as quickly as possible. If you want to get onto the property ladder and that type of thing with the lowest interest rate type, and I think Sipamandla did touch on this earlier, it might be a good time, but just bear in mind that interest rates might start ticking up, so you want to protect yourself against that as well. But be cautious about going into extra debt at the moment, specifically that expensive type of debt that is lifestyle oriented.
Thank you, Esther. Fantastic. Thank you so much to all of our panelists for making time in their busy diaries to have this discussion today. Thank you so much to all of our media attendees for joining us in this discussion and unpacking some of COVID-19's implications. Just a reminder that if any media companies want to set up personal interviews with any of our any of our panelists, please just send Leka or Pelile an email directly, and they will facilitate that. Thank you so much. Stay safe in this time, and I'm sure we'll see you all soon.